I'm going to tell you about one of the most important stock investing principles ever invented, the principle of Mr. Market. The Mr. Market analogy to the stock market comes from Chapter 8 of the Intelligent Investor book by Benjamin Graham. And Warren Buffett himself calls it the most important chapter of a book that he still considers to be the most important book for stock investors. Once you understand this concept, you're never again going to have to feel anxious when a stock that you own is going down in price randomly. More importantly, you're going to become one of the very few investors that can actually take advantage of generational buying opportunities when everyone else around you is panic selling. So, let's get right into it. Hey everyone, I'm Richard Hopkins and welcome to another video. If you're new here and you want to learn how to invest in stocks successfully and reach financial freedom sooner, then start now by hitting subscribe and ringing the bell so you don't miss anything. The Mr. Market analogy is making a comparison between owning shares in a public company traded on the stock market and owning a small interest in a private company while having a bipolar business partner. In the analogy, Mr. Market is the stock market. Listen, Mr. Market is just a fictional made-up character by Benjamin Graham created to represent the stock market. Mr. Market, the fictional character, is bipolar, meaning sometimes he can be extremely depressed and sad, and sometimes he can be extremely optimistic and enthusiastic. Benjamin Graham is telling us that the stock market is the same way. So in this video, when you hear me say Mr. Market, just realize that we're talking about the stock market. In the same way that the stock market gives you a quote on your shares every single day, Mr. Market, your business partner, comes to you each and every day and tells you what he thinks your investment is worth. And he even goes one step further still by offering to either buy you out at that price or to sell you an additional ownership interest at that price. And without fail, he comes to you with this quote and offer every single day. Some days when he comes to you with his estimate of value, it sounds reasonable based on your own knowledge of the business and its prospects. Although Mr. Market is often reasonable with his estimates of value, from time to time, being that Mr. Market is bipolar, he occasionally comes to you with extreme excitement and optimism, suggesting a value that is way higher than your own rational estimates. And sometimes when he comes, his anxieties and fears have completely taken over, and the value that he proposes is extremely low compared to your own rational estimates. Listen, the most important part of this analogy is very often missed. You have to remember that Mr. Market not only quotes you a price, but he also offers to buy your share or sell you more at that price. Seriously, think about that for a second. Let's say that you own a small share in a private business that costs you $1,000. And as a minority shareholder, you're essentially a silent partner in the company. Would you let the views of your bipolar business partner, Mr. Market, determine your views on the value of your $1,000 investment with his constant and ever-changing daily updates? Would you let his irrational fears or enthusiasm be infectious, or would you stay level-headed? If you're someone who's sensible and rational and level-headed, you might actually see having Mr. Market as a business partner like this as a good thing. Because on certain days, you might be happy to sell your shares to Mr. Market when he offers you a ridiculously high price. And on other days, you might be equally pleased to buy more shares of the business when he offers a price to you that's particularly low. The point is that you have the option, but you can also choose to ignore him. Benjamin Graham's lesson here was that it was a blessing to have a business partner like Mr. Market who gave you these options all the time. Basically, you need to use your own rational and unemotional judgment of value rather than relying on the very often bipolar stock market, aka Mr. Market, to tell you what the value of a stock is worth. As you could imagine, simply knowing the concept of Mr. Market isn't going to be enough to completely safeguard you from getting sucked into the fear and greed and panic and exuberance of the stock market. Warren Buffett's business partner, Charlie Munger, has pointed out that even the most competent people don't always make decisions on a purely rational basis. Sometimes we can actually be our own worst enemy. Have you ever noticed that before? And this is why Charlie Munger actually puts so much importance on the psychological factors that affect our judgment and decision making. At some point, you should definitely check out Charlie Munger's speech called The Psychology of Human Misjudgment if you want to learn more about this. And you should also check out this book, Influence by Robert Cialdini. It's one of my personal favorites, and it's also one of Charlie Munger's favorites as well, so you should read it ASAP. If, by the way, you've read this book already, comment down below and let me know what you thought. So here's the easiest way to stay rational and level-headed amidst the bipolar nature of the stock market. It's to know what you own. Because when you know what you own, when you know the business behind the stock, it's a lot easier to stay rational and level-headed compared to the people who are treating the stock as if it's some kind of lottery ticket. I want to share with you now a quick clip from a Peter Lynch speech where he makes the point so perfectly.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. If you're just buying on the fact the stock had gone from 26 to 16 and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do?
Awesome, right? Can you see now how it could be pretty easy to get influenced by the bipolar Mr.Market if you don't understand the business you own or really have any idea of what it's actually worth? The right idea is to understand the business you're buying and come to a conclusion of what it's worth first and foremost. Stock prices will wiggle above and below their intrinsic value over time. Your job is to wait for the price to wiggle below what you think it's worth before buying, or to at least wait for it to be trading at a fair value. You've already learned from other videos on this channel that even the most incredible business can be a bad investment if you pay way too much for it. If the stock you like is currently too expensive, you can wait, or you can simply add it to a watch list for later and move on to find another stock you like that is currently trading at a price below its intrinsic value. So the chapter we've been talking about here in this video, chapter 8 of The Intelligent Investor, the chapter about Mr. Market, has one major piece of advice I'm going to give you, and it comes from a direct quote in the book. And it's something you should consider printing off in large fonts and pinning it up on the wall in your office so you never forget it. However, before I go any further in this video, I need to first tell you about something called the efficient market hypothesis. I need to tell you about this now because all of this Mr. Market talk is in complete opposition to the efficient market hypothesis theory. Believers in the efficient market theory would say that stock prices are always perfectly efficient and that they reflect everything that is known about a company's prospects and the state of the economy at any given moment. They would say that there are never any undervalued or overvalued stocks. And the reason they'd give you is they'd say that there are very smart stock analysts who use all of the available information which ensures unfailingly perfect stock prices at all times. These efficient market theorists would say that anyone that beats the market year after year is really just lucky. Now, hopefully as you're watching this right now, you're already noticing the absurdity of this efficient market theory, especially if you've ever owned any stocks. In spite of the ridiculousness of it, this theory, developed by an economist in the 1960s who, let's face it, probably never owned any stocks, somehow managed to stick. It's since been printed in countless economics textbooks and preached by business school professors everywhere for decades now. Only recently has its prevalence started to very slowly die off. There are a bunch of reasons why the efficient market theory is obviously completely wrong, but here's my favorite reason why. Benjamin Graham's investment philosophy was heavily focused around buying stocks he called net nets. Warren Buffett had another name for them. He called them cigar butt stocks. And they're also called net current asset value stocks. If the stock market was efficient, net nets should never exist. A net net stock is a stock that is trading for less than its net current asset value. Here's what I mean by that. To calculate the net current asset value of a company, you simply take the current assets and subtract total liabilities. Let's say a public company trading on the stock market has current assets of $20 million. $8 million of cash, $4 million of short-term investments, $2 million accounts receivable, and $6 million inventory equals $20 million of current assets. Don't forget, we're not even including any long-term assets like properties, plants, equipment, etc. Just the current assets that could be liquidated for cash fast. So let's say this company also has total liabilities, both current and long-term liabilities combined, of $5 million. This means the company has a net current asset value of the 20 million current assets minus 5 million total liabilities equals $15 million of net current asset value. If this hypothetical public company has 1 million shares outstanding, then the net current asset value per share would be the $15 million net current asset value divided by 1 million shares outstanding equals $15 net current asset value per share. Benjamin Graham liked to buy stocks when they were trading for 2/3 of their net current asset value. This means that when Mr.Market, aka the stock market, gave Graham the opportunity to buy this stock for $10 or cheaper, this is when Graham would become interested in buying these shares. Mr.Market would be serving up opportunities to buy shares of companies for literally less than they could be liquidated for. And you have to understand here too, that sure, these companies that Graham and Buffett would buy were not the most amazing companies, but they were certainly legitimate companies. I'm talking about companies that were profitable, had been profitable in the past, built up retained earnings, and would continue to be profitable in the future. Real businesses. And meanwhile, selling on the stock market for less than they could be liquidated for. Like I said before, if the stock market was efficient, this should never be possible. Let me put into perspective for you how crazy this actually is. Let's say that instead of it being shares of a public company trading on the stock market, that it was a private company owned by an individual, or let's say it was a family business. If you went to the owners and offered to buy their company for the net current asset value of $15 million, they would not just reject your offer, but they would be so offended that they would kick you out and they would never want to hear from you ever again. Yet, back in those Ben Graham years and early Warren Buffett years, there were a lot of stocks to be found trading below their net current asset value. Big companies included. These net investments were how Buffett started in his early years with his Buffett partnership, which had a compounded annual growth rate of an amazing 29.5% from 1957 to 1969. Berkshire Hathaway, Warren Buffett's company, was actually a net stock. It was originally a textile company selling on the stock market for below its net current asset value when he started buying up shares to the point of eventually having a controlling ownership stake. Here's a quick clip of Warren Buffett talking about cigar butt stocks.
I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. Berkshire was selling below its working capital per share. You got the plants for nothing, you got the machinery for nothing, you got the inventory and receivables at a discount. It was cheap. So I bought it. I could have sold Berkshire or perhaps liquidated it and made a quick little profit, one puff.
These days you can find some net stocks, but there's not very many around, not like there once was, especially not in America. Buying net, aka cigar butts, is certainly not the only way you can make money in the stock market. In fact, Warren Buffett's investing methods have seriously evolved over time. He always continued to value companies and buy them when they were trading at a discount to their intrinsic value. That never changed. But something like having a low price to net current asset value became much less important to him. And things like finding companies with consistently high return on net tangible assets and companies with long-term competitive advantages became much more of a focus for him. The major influence that Charlie Munger had on Buffett was convincing him that the better way to invest in stocks was to buy wonderful companies at fair prices and hold them forever. One of Buffett's more famous quotes is, "It's better to own a wonderful business at a fair price than it is to own a fair business at a wonderful price." This new era Berkshire Hathaway investment idea came from Charlie Munger long ago. So this video is not done yet. However, I needed to tell you about net just now because I really needed to drive home the point to you that the stock market is not perfectly efficient. So while it is mostly efficient, there are definitely plenty of opportunities to find stocks that are mispriced. Mispriced higher than they're worth, and even more importantly for us investors, also mispriced lower than they're worth, and on a regular basis. So here comes the final piece of information that ties all of this together. The main thing to know about Mr. Market is that he's there to serve you, not instruct you. You can take advantage of the daily market price, or you can just leave it alone, as dictated by your own judgment and inclination. Sometimes large price swings may be a signal that you should re-examine the company that you own. But for the most part, as long as the fundamentals of the business remain in place, you're going to be better off ignoring Mr. Market's craziness, aka the craziness of the stock market, completely. And instead, just pay attention to the operating results of your companies in the quarterly and annual financial reports. So here's the direct quote that I mentioned earlier with actionable advice from Chapter 8. Benjamin Graham says, "The investor with a portfolio of sound stocks should expect their prices to fluctuate and should neither be concerned by sizable declines nor become excited by sizable advances. One should always remember that the market quotes are there for their convenience, either to be taken advantage of or to be ignored. One should never buy a stock because it has gone up or sell one because it has gone down." He would not be far wrong if this motto read more simply: never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. So print that last sentence off in large fonts and pin it on the wall in your office or whatever room you do most of your thinking in, just as an extra reminder to always stay level-headed. And here's one more great quote to add to your collection, and it's one of my personal favorite Benjamin Graham quotes. He says, "Investors should purchase stocks like they purchase groceries, not like they purchase perfume." Yo, you just learned one of the most important fundamentals of stock investing. You should be feeling amazing because this is actually a huge milestone in your journey to successful stock investing. If you don't fully understand this yet, that's okay. Just go back and watch this video until you fully internalize this lesson. And also, please share this video with someone you think is going to benefit from it. And remember to subscribe right now for videos every single week. And if you want to keep feeling great and you want to keep learning, the next one for you to watch is right here. So click or tap here right now and keep that learning momentum flowing. And by the way, if you like this video and you haven't yet hit the like button, what's going on? It really helps out and it's super encouraging to see those likes coming in. So go ahead and smash that like button for me right now and I'll see you in that next video.